Welcome to The Explainer. Today, we are diving deep into a trading idea that's actually a century old, but it's being rediscovered and, frankly, perfected by modern algorithms. We're talking about the hunt for sister stocks, stocks that are practically joined at the hip, and how traders try to profit when they have a temporary falling out. And you really have to start with this guy, the legendary trader Jesse Livermore. This quote was his whole philosophy. Back in the early 1900s, he was absolutely obsessed with finding a way to make money, no matter which way the market was heading. He wanted a strategy that didn't care about bull markets or bear markets. So how did he chase this market-neutral dream? Well, you got to remember, this is a guy drawing stock charts by hand. And he came up with this really elegant, super intuitive concept he called sister stocks. The idea is beautiful, right? It's so simple. Find two companies, maybe they're direct competitors, maybe they're in the exact same industry, whose stocks tend to move in lockstep. His whole theory was that by trading the relationship between the two, he could basically ignore all the noise and chaos of the overall market and just focus on this one predictable dance. Okay, but here's the catch. Relying on just your intuition is risky. How do you really prove that two stocks are truly connected by some economic force, and they're not just moving together by pure random chance? So for decades, this whole idea kind of stayed on the fringes. It was a cool concept, but it wasn't rigorous enough. That all changed in the 1980s, when economists finally gave it a rock-solid mathematical backbone. They came up with something called cointegration. Now, don't let the fancy term intimidate you. Look at the formula on the slide. It's the key. All it's really saying is that we can prove, mathematically, that these two stock prices are tied together in the long run. We can pretty much predict the price of stock A just by looking at the price of stock B, scaling it by some factor, and knowing their usual spread. It's a game changer. And this is the perfect way to think about it. I love this analogy. You've got two dogs. They can sniff around. One can run a little ahead, the other can lag behind, but that leash, that statistical leash, always eventually pulls them back together. So you're not betting on where the dogs are going, you're betting on the leash. So we have this powerful idea. How do we actually use it today? Back in Livermore's time, finding just one of these pairs was a ton of manual, painstaking work. Today, we want algorithms to sift through thousands of stocks and find the absolute best pairs. That means analyzing millions and millions of potential combinations. Just to put that in perspective, if you start with about 10,000 stocks, you're looking at nearly 50 million possible pairs to analyze. There is no way a human being could ever do that. It's just not possible. The only way to tackle it is to build a high-speed, fully automated, algorithmic pipeline. And this is how it's done. The whole process is set up like a funnel, and it's incredibly efficient. So step one, it just sucks in a massive ocean of data. Then step two, it immediately throws out all the junk, penny stocks, stuff that barely trades. Next, it does a quick and dirty correlation check to find pairs that look promising. And here's the genius part. Only the very small handful of pairs that make it to the end, to step four, get the full computationally expensive Cointegration analysis. But here's the thing, and this is where it gets really, really clever. Just finding a pair that looks perfect in a spreadsheet of historical data, well, that's not good enough. A lot of these relationships that look solid on paper are actually super fragile and would just completely fall apart in the real world. So this is really the leap from a basic statistical tool to a truly professional, industrial-grade system. You have to ask the hard questions. Is this relationship stable over time, or was it just a fluke? Does that leash stretch or break when the market gets crazy? And maybe the most important question of all, after I pay all my trading fees, is there any actual profit left? And to get those answers, modern systems add these extra layers of stress tests. They check for rolling stability, which means they look at the relationship in a bunch of different time windows to make sure it holds up. Then, and this is so important, they do a transaction cost analysis. It calculates what's called a break-even z-score. All that really means is it figures out the bare minimum the stocks have to diverge for a trade to even cover its own costs. It's the "is this actually worth it" test. And finally, they test it on data the model has never seen before, just to make sure the pattern is real and not some weird coincidence from the past. All right, so after you run 50 million potential pairs through this absolute gauntlet of filtering and testing and stress testing, what do you actually have at the end of it all? You get this, not some messy spreadsheet, but a clean, ranked list. The engine is smart enough to combine dozens of different metrics, everything from the pure statistics to the stability and the real-world tradability, and boils it all down into one single composite score. This lets a human trader just glance at the list and immediately see the most robust, most promising pairs the algorithm managed to find. And that's really why this all matters. This isn't just about one trading strategy. The journey from a trader's simple gut feeling to this incredibly complex, automated system, it shows you a fundamental shift in how markets actually work. We've moved from human observation to algorithmic precision. An edge in the market is no longer just found, it's engineered. When you get right down to it, this modern hunt for sister stocks is the perfect picture of the arms race that's always going on between human intuition and pure, raw computing power. The core ideas might be old, but the tools we use to find them are getting exponentially sharper every single day. And that kind of leaves us with this one big, fascinating thought. Remember Livermore's goal? It was to always be on the right side of the market. Well, today, the right side is increasingly being found not by human instinct, but by algorithms that can spot patterns that we could never hope to see. And the implication of that is huge. As this algorithmic arms race just keeps accelerating, the very definition of what a market edge even is, it's being completely redefined right in front of us. The hunt is still the same, but the hunters are evolving.